What if I told you there's a piece of financial advice out there, advice that sounds super responsible, but it could actually be one of the most expensive mistakes you ever make with your credit? Yeah, we're going to talk about a myth that millions of people believe, and honestly, it could be costing you a fortune.
So let's just rip the Band-Aid off. The big question is this. Could closing a credit card, you know that old one you never even use, could that really cost you $54,000? It sounds absolutely insane, right? But believe it or not, the answer is yes. And I'm going to show you exactly how that happens.
All right, so here it is. This is the myth. Closing old or unused credit cards will improve your credit score. Come on, you've probably heard this before, right? Maybe you've even thought it yourself. I mean, it makes sense on the surface. Fewer cards, less temptation, you look more responsible. It sounds so logical, but it's a total trap.
Yeah, because that advice, it's completely 100% backwards. Closing that old card doesn't help your score. Nope. In fact, pretty much every single time, it hurts it. And sometimes, it hurts it a lot. So, the big question is, why?
Okay, so it all boils down to two really important things that make up a giant piece of your credit score. We're talking credit utilization and your credit history. When you close a card, it's like you're throwing a wrench into the gears of both of these at the exact same time. It's a double whammy. Let's break down that first one.
All right, credit utilization ratio. I know, it sounds super technical and boring, but I promise it's not. It's just a percentage. All it is how much you owe compared to how much credit you could use. Think of it this way. Lenders want to see that you're not living right on the edge, maxing everything out. So a low ratio, that's a very, very good thing.
And the math here is actually super simple. Let's walk through it. Imagine you've got two cards, right? Each one has a $5,000 limit. So your total available credit is 10 grand. Now let's say you have a $2,000 balance. That means you're using 20% of your available credit. That's great. But watch this. You decide to close one of those cards. Your balance is still $2,000. You haven't spent anything new, but your total credit limit just got chopped in half. It's only $5,000 now. And just like that, boom, your utilization doubles to 40%. Instantly.
And just like that, you've done some serious damage. You went from a perfectly good 20% utilization, which is way below that 30% sweet spot lenders love, to a warning level of 40%. Literally overnight. And get this, you didn't even spend another dime. To a lender, though, you suddenly look way riskier. And your score, well, it takes a hit.
But wait, there's more. That's only part of the problem. The second way this whole thing backfires is by messing with your credit history. And when we talk about history, it's all about age. See, lenders absolutely love to see a long, stable track record of you managing your credit well. Believe it or not, the age of your credit accounts makes up a solid 15% of your FICO score. So when you close your oldest card, you're basically taking your team's MVP off the field. The average age of all your accounts drops, and that beautiful, long history that screamed, "I'm reliable," well, it suddenly looks a whole lot shorter and less impressive.
Okay, so your score drops. You might be thinking, what's the big deal? A few points? Whatever. Well, hold on. Those few points can translate into a shocking amount of actual, real money. Let's get concrete and look at a mortgage example, because this is where it really hits home.
All right, let's say you're starting out strong. You've got a great score, a 750. You're in the big leagues now, ready to get the absolute best interest rates on a huge loan like a mortgage. And then you get that bright idea to clean up your finances. You decide to close that old credit card that's just been sitting in a drawer. But because of that double whammy we talked about, the utilization spike and the hit to your credit age, your score tanks. It drops 70 points down to 680. Now that's still an okay score for sure, but you're not in that top tier anymore.
So now you go to apply for that $300,000 mortgage, and that 70-point drop? Oof, it could easily mean you're getting a higher interest rate. And we are not talking about a few cents. That difference could cost you an extra $150 every single month. I mean, that's a car payment for some people. It's your grocery bill. It's gone.
But this is where it gets just mind-blowing. $150 a month, okay, it hurts, but it might not sound like a total disaster. But what happens when you pay that month after month over a 30-year loan? It adds up to $54,000. Just let that sink in. 54 grand and nothing but extra interest. All from one simple, common mistake.
Okay, so that's pretty terrifying. How in the world do you avoid this incredibly expensive trap? Well, the good news is, the solution is actually really, really simple.
So let's talk about the smarter way to handle this.
All right, step one, and this is the big one. Just keep those old cards open, especially if they don't have an annual fee. The best trick? Put a tiny recurring charge on it, like your Netflix or Spotify, and set it to autopay. That's it. The account stays active, your history keeps getting longer. Okay, step two. If you absolutely must close a card, maybe it has a crazy high fee, always close the newest one first. That'll do the least amount of damage to your credit age. And finally, number three, focus on what really matters. Lowering your utilization by paying down your balances. That's the stuff that really makes you look like a rock star to lenders.
So really, when you boil it all down, the takeaway is super simple. It's a mantra you can just repeat to yourself. Keep old cards open. Keep balances low. That's it. Seriously, that's the secret. That's how you make your credit score work for you instead of letting some silly myth work against you.
So what do you think? I mean, be honest. Have you ever been tempted to close an old card? I think a lot of us have. This is the kind of stuff that can save you actual serious money. So if you want to understand your finances better and avoid more of these expensive myths, do me a favor and hit that subscribe button for more explainers just like this one. Thanks so much for hanging out.